Hi, it's Jeffrey Cohen, Chicago Quantum. How are you? So, been a while since I've been recording, so I decided to come in. I will be taking your questions and moderating the chat. So, if you have any thoughts, you have any questions, go ahead, ask me anything. We're going to talk today about the stock market. We're going to talk today about our model runs. We're also going to talk today about thermonuclear war. We got a lot on the plate today. I got to tell you, there's a lot going on. And also, I'm going to share some personal information. So, get out your notebooks, because it's going to be a lot of fun today. So, thermonuclear war, stocks that we own, overall stock market point of view. We'll talk a little bit about the debt ceiling. We got so much to cover. I can't even take it. I may have to turn an overhead light on just so you can see me better. What do you think? So I'm Jeffrey Cohen. I'm president and founder of U.S. Advanced Computing Infrastructures Incorporated. It's the Friday before Memorial Day weekend. Markets are closed Monday. People say, sell in May and go away. Well, it's May 26th, and actually the market's been going up. So, maybe you're supposed to sell in May, but I don't know. Things look pretty optimistic to me. And so I'm going to start off just by talking about a few stocks that we're in. So, Yellow. Yellow is a trucking company. Less than truckload trucking company. So think of them like FedEx, but more for businesses. So, well, first off, you better have a strong economy, because FedEx or UPS for business, both local and long distance, has got to have, a lot to it. And so what you see is when the market crashed during COVID, it went to $1.50, climbed back up to like $12 because, it made sense, right? But now it's back down to $1.25. And so the whole point about Yellow is it's like the whole economy on steroids, right? So what are we going to be investing in? And so if we build inventory, right? They've got I'm so distracted by that stupid ad. I have no idea what that ad is about, and I sure wish I could hide the ad. Block floating videos. I'm so distracted by that. It makes me want to throw up. So, I'm sorry. I know I shouldn't be distracted, but it's just terrible. It's terrible. So, but you can see Yellow is down. And so, if you just look at the basic financials, and by the way, I can tell you from a friend of mine, I don't use Yahoo Finance for my financials, but it's just a good look. So the total assets of the company are 2.1. Total liabilities are 2.5. That means this company is already as good as bankrupt. It's worth negative. It's a terrible company. It's a terrible company. You look at the amount of debt it has. It has $1.5 to $1.6 billion in debt. The only reason it's not to zero right now is because the U.S. federal government owns a lot of that debt. I want to say $800 million of it is U.S. federal government debt, and the reason that the federal government lent it to them. So Jeffrey, why would the federal government lend Yellow a whole bunch of money? Well, the reason they did is they used it to buy equipment, truck trailers, truck tractors, and to keep a lot of Teamsters employed. They took a third of the stock, though. They got a third of the stock. And so that's good. It was a good deal for the U.S. government. Now, unfortunately, they took the stock, and now the stock's at $1.25. But this is what's going on. And so this is a bet on the future. This is a bet that the Teamsters are going to make nice. That they're going to make nice, that they're going to allow them to become more efficient, and it's all going to work out. So we're in, and I'm so distracted by that stupid video. I can't even tell you Can't even tell you. All right. So if we look at how yellow is trading today, you can see there's not a lot of shares at the bid and the ask at 127. But you go down to $1.25, there's plenty, there's going to be some shares at sale for $1.30, $1.35, $1.40. This is just not really trading. It's being pounded lower. Truthfully, and this is unfortunate because I own some yellow, not a big position, a small position. I think it goes under $1. And I'm so depressed because I own the stock and I'm just going to take a friggin' bath on it. And so yellow doesn't have anything going for it right now because they've got union negotiations coming up. They've got to get the union to agree to one yellow, which is a consolidation play. By the way, FedEx has a one FedEx. So FedEx is doing it. But yellow can't get them to do it. And so everyone's holding yellow hostage. It's a small profit business anyway. I mean, if we go back to the financials, take a look at the income statement. They generate $5.25 billion of revenue. That's great. The cost is 90% of it. Then you have operating expenses. Next thing you know, you're down to a 3% margin. Now they got to pay interest, so you lose money. That's it. It's a simple model. They're basically making enough money to pay interest on their debt. So the only way they recover, that they do well, that they drive profit, is to get that gross profit up, which means become more efficient. Operating leverage. It's a bet on a turnaround. You're going to see that all three of my holdings are bets on turnarounds. So this is one of them. Yellow, and no one believes. That's the problem. No one believes it's going to turn around. So you're lonely. You're in yellow, you're lonely man. Okay? Now the next one is ATI Physical Therapy. Now ATI Physical Therapy is trading right around 1930 to 1960, 1910 to 23, 1930 to 1960, 19 to 23. So you could pick up some shares under 20 cents a share. It's cheap. ATI Physical Therapy right now is cheap, but there's almost no volume. So let's take a look at 66,000 shares at 20 cents is 15 grand traded all day. That's nothing. So the stock is not trading, and you can see 20,000 traded at 1947. Someone's taken a position. Now what that looks to me is that somebody sold at 1947. I don't know. Maybe that's right where the market was. Maybe they just did a market order for 20,000 shares. Who knows? I love the stock. I think it's great. I think this thing's going to go to the moon. But talk to me about ATI Physical Therapy, Jeff. Well, what I tell you is it's a declining, it's a very, very bad story. It's a declining story. So take a look at the income statement. It generated in the last year. Again, I don't like to use Yahoo Finance for the financials. I get it. It's just very convenient. So you look at total revenue at 630 million. You should be able to make profit on that. I mean, I ran a consulting business at about that size. You can make a profit. You can stop spending on bullshit, and you can drive revenue, and you can collect your receivables, and you can make a good business. It's not a bad business. So today, they made a gross profit of about 12%. Not bad. Maybe get to 20, I don't know, but 12. Now their operating expenses well in excess. And part of what it is now is that they rolled over their whole management team and had to pay severance. So I get it. Moving forward, although it's not that much down or up. So maybe you're talking 120. So they've got to drive a 20% gross profit to pay their operating expense. That seems high to me. That seems like, number one, cut your operating expense. Number two, interest running at like 40 million, you can pay that. You can pay that. So you just gotta recover, basically. You've just gotta, in this business, you gotta drive up your revenue. Quit farting around. Get some more revenue coming in. Focus. Focus on outreach to physicians, to the community, and drive it. Because here's the thing. From a cash flow basis, you're bleeding. The only way you've been surviving is by financing the business. And now you're out of money. You can't finance jack duty wop. You're out. You're out. No more financing. So you got to raise the money through cash flow. I got to tell you, don't be a bunch of pansies. I've run labor-based businesses before. It's not hard. You just got to be a bit ruthless. But you can do it. I know you can do it. So it's a turnaround story. It's a tough story. Okay, we're going to take a look and we're going to see somebody sold through. Somebody sold through 1930. We are at 1910, 1921 a share, right? So somebody just blew out the buys. That's fine. Take down the asks enough and you might get some business, right? So now you're at 1956. 1956 looks pretty damn attractive for this. There's your 1956 right there. I'm looking at the book viewer. So I like it. I understand that people don't like me talking about it either. They feel bad. They feel like, oh, Jeff, this thing is a bankruptcy play. You're the only sucker out there. And I have to admit, I might be the only sucker out there. I'm a sucker. I think this is a turnaround story. I think it's happening. I think they're helping out the kids. By the way, there was a nice tweet that was put out by a customer. See if I can find it. Right here. Right here, Marcella Berry, and this was not by the company. After 2 hip dysplasia surgeries, she had trouble running like the other kids. And so they worked with her. Now she can run again. It's a little kid. They should be able to run. And I had knee surgery. I went to an ATI physical therapy. Do you know why I went? Because my doctor's office didn't have capacity. This is before COVID. So they sent me to ATI physical therapy. I had 6 appointments. Do you know they helped my knee to fully recover? 6 appointments. So figure it was $700 they took in. Insurance, $700. I'm right as rain. You know, I'm training for a marathon now. I love ATI physical therapy. I think it's great. I think there's a good spot in the market. Now, if you want like a therapeutic massage, that's a different business, right? They got plenty of places for massage. But this is medical treatment for $100 a visit, $103 and change a visit. It's good business. That's all I'm saying. So I'm long. Seems like everyone else and their brother is short. I get it. You're at 1928. I mean, this thing could go to 10 cents. And unfortunately, I'm going to keep buying it. I'm out of money, too. I don't even have any money to buy it. But I'm probably still going to buy some. Just the way it is, you know? Now, what's the third stock you've got, Jeff? So the point here is ATI Physical Therapy needs to improve operations, improve their cash flow, their day sales outstanding, and tell us that they're doing it. Because otherwise, as you see in the financials, they're just going to chew up all the money on new clinics and operating cash flow. And if you look at the balance sheet, there's not that much left. How much money they have left? They got $83 million, right? That's going to last like 6 months, and then they're bankrupt. They got to turn the ship around. And they have to do it now. Okay? Do it now, guys. ATI Physical Therapy today. Call me. I'll come in for nothing. And I'll help you. I used to be the Grim Reaper at McKinsey & Company. I know how to cut costs. I can help you with this revenue cycle. I can help you think through the physician referral networks. Come on. Get the business going. Because now I'm bleeding. I'm bleeding out every hole on my ATI Physical Therapy long position. All right. Next stock. Summit Midstream Limited Partners. First off, I love this company. I love the stock. I've held it before. I'm back. It's a master limited partnership, so it's a little bit different. So where is the SMLP? Here it is. This is their May information. So when you ask me, Jeffrey, who is Summit Midstream? I'll tell you, look, I don't know. I'm not an oil guy, right? This isn't my business. I'm a businessman. I'm not an oil and gas guy. But I will tell you this. I'm learning. They are well positioned in key oil and gas markets. These are unconventional, aka shale, producing business areas. They're in the Permian. It's called the Delaware Basin of the Permian. They're in the Williston, a little bit up in the back end, right? North Dakota. They're in the DJ and the Pissants, Denver, Jules. The DJ is where Chevron is buying PDC Energy. It's a great shale region. But Colorado is slowing it down. You're in the Barnett, which is old legacy Texas oil. And you're in the Utica and Marcellus. I want you to think Appalachians. I want you to think Ohio, West Virginia. Those wells, they produce a lot of gas. In fact, the Utica, Marcellus, those regions, those plays, produce over 32 billion cubic feet a day. The only reason they don't produce more is they don't have enough pipeline takeaway. So, love it. I love where they're at. Okay? They got a good customer base. So the question is, can you grow the thing? The only way this turnaround story is going to make it is they've got to increase utilization of the pipelines. They got to grow. They got to grow. Northeast segment. I want you to think Appalachia. I want you to think Ohio, West Virginia. I want you to think 41 new wells in 2022, 75 to 85 new wells in 2023. That's going to be great. In the Rockies, where they just made a huge acquisition. They spent $320 million, inclusive of the cost to integrate the new pipelines. They bought 2 new pipelines in the DJ just before Chevron announces the acquisition of PDC Energy. They're on fire, baby. They're on fire. 61 new wells going to 140 to 180. I love that story. That's a good story, okay? Big acquisitions. We're going to love that story. The Barnett, sleepy. I know. I mean, like Fort Worth is sleepy. 15 new well connects estimated. 12 last year. There's not much going on there. Now, the Pissants, this one's interesting. Not a lot of drilling, but where there's drilling, it's in SMLP's area in Garland County. 55 new well connects expected. I love it. 17 are already drilled. I want to say April, they had another 8 or 9 connect. So 17 connected already. That's nice, right? You can see 4 well connects in the Northeast. By the way, that's out of a total of 25 rotary rigs operating in the entire states of Ohio and West Virginia. I love the story. I love the story. The Rockies, it's all about being thoughtful, making acquisitions, driving into that DJ basin. It's what I call a leadership role in terms of pipelines in that area, because now they're what do they call it? A franchise play. 3 pipelines interconnected, coming together. It's good. Barnett, nice to see a rig. Thank God. The Pissans, same thing. Now the Permian is interesting. The Permian is all about double E. And we're going to talk a little bit about the double E pipeline. The double E pipeline is a 1.35 billion cubic foot pipeline that connects from New Mexico, or what I'll call the northern Delaware, into Waha, which is in Texas, which is like the southern Delaware. That's where PDC Energy operates, near the Waha. And from the Waha, there's a lot of pipelines that take you to the rest of the country. So if you can get the gas from the northern Delaware down, you got a market for it. So you can start doing more drilling. Double E is a good opportunity. It's 70% owned by SMLP, 30% owned by Exxon. It's good. So the Red Hills lateral. The Red Hills lateral pipeline is important because this connects them into another 600 million cubic feet per day. So I want to show you this. This is oilandgaswatch.org, pipeline 5960. In yellow, we're gonna make this a little smaller for you, help you out a little, right? In yellow is the double E pipeline. Comes down to Waha. Lots of work down there. Lots of interconnection. I love it. It's great, right? But up here, up north, there's not much. Right? There's a double E lateral right here. And this red is what they've gotten approval to build. It's going to cost probably a little under $40 million, and it's connecting him to the Red Hills gas processing, which is a very, very active gas processing facility. 600 million cubic feet. There's drilling activity happening there right now. It's good, and then the optionality is they could probably connect up to Big Lizard if there's enough capacity. So you get that going on, and you can really build this up. It's good. You can also continue to move east to the extent that there's good drilling going on there. So I like this. I like the double E story. I think it adds some good earnings horsepower to the business. But it's all going to take time. Why is it going to take time? The EBITDA bridge to this year, 2023, says they get somewhere from 290 to 320. Now, there's 10 million shares, roughly speaking. Maybe it's 11. Close. So make it 11 million, make it 330. Make it 10 million, make it 300. Same thing. So they're going to generate $30 of EBITDA per unit. But they owe 1.34 total debt. 1.34 billion. So it's a fair amount of debt. That's if they're producing 30 million of EBITDA, you're buying 134 in debt for every unit. It's a little heavy. It's a little heavy. And so they're going to have to pay it down. They're either going to have to grow EBITDA or they're going to have to pay down their debt. It almost doesn't matter either way, right? Either way. So I like the SMLP story. I do. And you can see how they're going to operate across the different regions. The Rockies becomes the big producer here. 23 million of EBITDA. The Northeast at 18. Always an important contributor. And Pissants, they do. They have a key position there. And the Permian, that's where I really want to see some growth. I'd love to see Double E go from 5 to 10 on a quarterly basis. They just got to drive it. There's not enough throughput. 264 million cubic feet a day of throughput is less than 20% of the nameplate capacity. So we need more. We need more drilling. That's the whole SMLP story. So I'm bullish. I don't see a problem here. Now we look at the financials. Again, don't use Yahoo Finance for your financials. It's fine. It's fine. Income statement. We'll look quarterly. So they generate $370 million. Gross profit of 170. They've got expensive overheads. You can see it right here. But I'm paying a lot of tax. Losing money. Losing my ass on this, right? Now the problem is with an MLP that I'm going to show all those losses on my tax return. So I don't know about you, but you know, I earn money, I earn income, and this makes it so that I don't pay tax on that income. This is negative income. Some of you like that. Personally, me, I don't like it. I want to pay more tax to the government, not less. So they are losing a lot of money here for net income. It's terrible. So interest expense of $100 million is what's material here. It's costing them a lot of money, right? They're generating $173 million in gross profit, but it's costing them $100 million in interest. So they got to pay down the debt. They've got to pay down the debt, and the only way you're going to pay down the debt is to drive up revenue and drive up EBIT. Actually, EBITDA. EBIT doesn't matter. It's actually cash flow for distributions. So I'm not really seeing the story yet, but I'm hopeful, right? You can see a little bit of growth here from 85 to 112. We need to see, you know, good quarterly revenue numbers. Get that number to 150, right? Get this revenue up to 600 million, and it's anybody's ball game. So we've talked about 3 stocks. We talked about Yellow. We talked about ATI Physical Therapy. And we talked about Summit Midstream. All 3 are small caps. All 3 are turnaround stories. All 3 are a belief that management can change the trajectory of a business. I believe it. I spent my whole career helping management teams change the trajectory of their businesses. And I think these guys can do it. So if we look at SMLP, you can see right now no one's willing to sell the stock for under 15. You got buyers at 1461, although not very much. Looks like 1440 is the real liquidity point here. So 1440 up to 1494. 1545. Oh, they offered at 1494. Somebody just bought it. I love it. It's a $20 stock. Let's be honest. SMLP, you're going to sleep at night owning that stock. And when you go to do your taxes, you're going to show a big loss. Big loss right now. Personally, I love it. I don't know about you. Maybe you don't want to show that you lost money, but for me, it's terrible. I make a little bit of money, and then I lose it all with my SMLP holdings. Terrible. So where are we with the game here? So ATI Physical Therapy is in the dumps. It's in the dumps. I hate this stock. This is a terrible stock. I'm losing my ass in this stock. I am so far down. Look at this thing. 27 cents a share, down to 19. Again, I think it hit 10 cents, no questions asked. I got Yellow, same kind of story, right? You try to catch a falling knife, you get your hand cut. Bought it at 175, drops to 127, think you go down to 50 cents for all I know. Now SMLP, a little bit of a different story. This is not such a sad story, right? You buy it at 15, 16 a share. It drops down. It comes back up. It's at 15 bucks right now. So not losing quite as much. So what else do I want to tell you? I want to tell you that we ran our model last night. We run our model every night, by the way. And you're going to notice that one stock is missing. Digital Turbine. Now, Digital Turbine was a favorite of our model. Ticker symbol APPS. And the reason is that the stock was very stable. Over a year, it's very stable. I mean, it would move and it would come back, right? It was very stable. Pretty flat. Now, downward trajectory. But what happened was it crashed like 40% yesterday on 20 million shares. And it did that because earnings were bad. Now it's up 11% because there's a lot of people that love this company. But this stock was a hero in our model because it had relatively low volatility for its beta. High beta, low volatility means attractive. But unfortunately, it went the other way, right? So they had a bad quarter, decline in revenue. In fact, it's been multiple quarters of declining revenue. Maybe the market doesn't believe. And so here you have it. So what I'm going to suggest to you is, if you're investing in the SMLP portfolio, the long portfolio, you probably want to hedge yourself against earnings releases. I don't know. Seems smart. The minute you start doing earnings releases, you're entering a lot of crazy volatility. And so that's where we're at. That's a key learning, right? Is be careful. Be careful with that. So we ran our model, and let's make it bigger. We're going to blow this thing all the way up so you can see it. So I will say that the variance of the S&P 500 continues to drop. The S&P 500 is now up 4.5%. After dividends, it's up about 2.8% for the year. That's not bad. The Russell's down. Look at the QQQ. It's up 16.5%. Before dividend, capital appreciation is 15.5%. You made money investing in tech. So tech is recovering. So why would tech recover? Because people are expecting interest rates to decline soon. Not yet. But growth looks good when interest rates fall. They're not falling yet. Just remember that. And we identify, we take out the foreign ones. We've identified a lot of foreign stocks for people that like to invest in foreign stocks. Personally, I want to stay away from them because they add a lot of volatility to the markets. They do. So, all stock variance. So, we ended up with 2,048 companies over $1 billion in market cap. It's 4.6 times 10 to the negative 5 variance versus like 3.4. It's a pretty low stock market variance. Affirm Holdings, that's the one that'll lend you money when you go to buy something like Uber Eats or something. The model loves that stock. It's just like Digital Turbine though. AFRM. AFRM is hugely volatile and risky in their business. But the stock acts like a well-behaved child. Sure, it went up. And sure, it's been going down. But if you look at it, very little volatility and lots of beta. So, you could have bought it at $9. This is about when our model started picking it, right around $9. And it's just been going up steadily. It's at 14. So you would have made 50% already, but that's not the point. The point is The model likes it, right? This is one of those stocks that the model just loves. And I'm sure that Chicago Quantum is not the only company running this type of model. And so lots of people are out there pumping it. Hits $9-10. They're pumping it like crazy, right? Popped it to 21, bring it down again. Who knows what it's going to pop to now. But again, if they have earnings or they have some kind of news, you want to be very careful, because you can only hold it looking pretty, painting the tape, laddering the closes long enough before market forces overwhelm you. And so there's other Bitcoin related names in here. MicroStrategy, Marathon. Not as many as there used to be. That's interesting, right? So you got Upstart, Coinbase, lots of new economy stuff. Block, Wayfair, Unity Software. So the model likes these newfound companies that are flatlined, that are down, that have consolidated for months at a time, where all the fun has been squeezed out of them. But yet, they're new companies. Look at NVIDIA. NVIDIA is number 19. NVIDIA has an attractive risk return according to our model. Now you're probably going to look at me like I'm crazy. NVIDIA, 20th best stock in the Chicago Quantum Net Score. Yeah. Because if you look at the stock, if you look at NVIDIA, it's going to look like a high beta, very high beta, right? Moves with the market without a lot of surprises. Look, it was down gently up and down, and then it's just like a steady rise. So steady rise means low volatility. It means low variance. Steady rise. It's beautiful. It's a beautiful stock, right? And so are you going to be the one that bets against it? I don't think so. But wait till the next earnings release. Because let's be honest, your dividend is 16 cents on a $400 stock. Your PE ratio is 222 according to Yahoo Finance. Company's worth $1 trillion. Yeah. There's a lot that could go wrong here. But if it doesn't go wrong, it's a beautiful stock. You buy stocks that go up, that have a nice, clean trajectory. That's our model, right? And so just be careful. I guess that's what I got to say here. And then the other thing I'm going to show you, just because I love it, right? You know, Chicago Quantum is the home of the negative beta stock list. There aren't very many stocks with a negative beta. Okay? There's 4. The rest are ETFs, which are giving you a synthetic negative beta, right? This is if you want a negative beta. Oh, wait. U-Haul. Bring it back in. There's 5. So there's 5 negative beta stocks. U-Haul, Innoviva, Crane, Chesapeake Utilities, and Acero Therapeutics. I don't really know any of these companies except U-Haul, right? And the story for why U-Haul would be a counter-cyclical stock makes sense. When times are rough, people got to rent a U-Haul for whatever, right? A couple $100, and they got to take all their crap and throw it in the back of the U-Haul and move. When times are good, you contract for a moving company. That's it. That's all I got to know. And there's a lot of negative beta synthetic plays here. So if you want to bet on the market going down and you want something that goes up when the market goes down, you go ultra pro short. You go daily small cap bear. You invest in the US dollar. You go for short-term VIX. And those tend to move in the opposite direction of stocks. That's interesting. Or you got a bunch of this stuff. Now, dividend-wise, where are we at with dividend payers? So we took out some of our model adjustments. And so the dividend stocks are back in. So you got a lot of weird stuff in here. Icon Enterprises, 18% historic dividend. You got shipping companies. You got Albertsons with a spinoff. Shipping. You got some master limited partnerships that had a big payoff, big payout. Compression Partners, another master limited partnership. You see those. B. Riley, 10% dividend. Crestwood Equity Partners, another master limited partner. So you got a lot of MLPs. And then you got like B. Riley. And you got weird stuff like shipping companies. So it's interesting. You got to really be careful if you're going to just buy, naked dividend stocks. But right now there's a big short play going on against Icon Enterprises limited partnership. So I'm not familiar with all the details, but that could be an interesting play for people. And PLX, I want to say that's associated with Marathon Petroleum, Antero Midstream, Equitrans Midstream, a lot of midstreams. Plains All American Pipeline, Magellan Midstream, Holly, Hess, Sunoco. A lot of midstream is paying nice dividends if people like that. But what's interesting is when you can earn almost 6% right now on short-term money, why would you buy a stock to earn 8%? But the stock has execution risk. I don't know why you buy it. Why don't you just put your money in treasuries? That's kind of where the model ends up, right? When you have all these conversations, the only way I really want to invest in this market is I want to buy really risky crap, right? Because it doesn't pay otherwise. You're not going to make any money, right? You're going to buy a stock with a 6% dividend versus just getting 6% in the bank. So what happens is the model says buy a firm, buy Wayfair, buy Mara, buy Unity Software, buy PacB, which is a biotech I never even heard of, right? Go crazy. Buy them all, right? And so what I say is, I get it. I get that an optimized long portfolio right now is a very risky long portfolio because interest rates are so high that you can't afford to just buy regular stocks. I get it. But then I look at the market. Like I look at the Russell 2000 and I see that the market isn't buying it. The market isn't buying it. The market is not buying Chicago Quantum net score recommendations. Because the Russell, although on a day like today, the Russell looks good, when you look at the Russell, it is up and down. It is choppy. And now, if you look at it since, March, it's been flat since March. And that's when interest rates have really started to rise. Really started to rise. And so, I get it. Let's draw a line. People like lines. I like a line. A nice, fat regression. Trend line. We'll do a trend line. From today, boom. The trend line all the way back to March 7 is flat. Interest rates go up. Nobody wants to be in the Russell. It's too risky. It takes too long to make money. By then you could be earning your 6% and wrapping it up. And so if we can get the debt crisis behind us, if we can get inflation licked, if we can do all that, and we get interest rates to come down, these things will scream higher. So we're in those stocks right now, and we are just bleeding while we wait. That's the whole story of the Russell right now. Hurts to wait. So, All right, I want to thank you for watching. I don't know if you got anything out of this. I don't know. I did. I look at this and I think, you could try to buy these little like rallies in the Russell, but it's tough right now. It's tough to make a play. It's tough to be long in this market. Especially if you're buying risk. If you're buying risk, you're in big trouble. So just be careful. I still think long term you want to be in risk because risk is how you're going to make the most money over time. You just might lose a lot of money while you're waiting. So, we had 2 people watching. That's pretty cool. No one gave a comment or anything, so I'm just going to drop it out. Thank you for watching. Happy Friday. Happy Memorial Day weekend. And we'll see you Tuesday. Bye-bye.